Some of the economic data to start off here. We saw China overnight lower their interest rates, but this is the kicker. They didn't lower it as much as the market expected. So again, rate cuts generally are viewed as a positive for the markets. In China, they lowered rate in terms of rate cuts. They lowered, but it was less than expected. So if we jump over here, this is the Hang Seng chart, right? So this is the Hong Kong stock market, which is the one I follow. And we can see that even with that rate cut, all right, even with the rate cut, it still caused the Chinese market or the Hang Seng to fall additionally. We saw a loss of 1.82%. So China continues to be in free fall.
Growing fears that property giant Country Garden may default on its debt have raised concerns about potential contagion in China's financial system after major developer Evergrande defaulted on more than $300 billion in debt in 2021. China last week also announced it would no longer publish detailed youth unemployment figures after the jobless rate hit 21.3% in June. The U.S. Central Bank just published minutes of its July policy meeting, and the records showed that at the time most Fed officials saw significant upside risk to inflation, which in turn may require even more tightening. On the other hand, two also favored holding rates steady, marking the first real hint of disagreement over the way forward that we've seen in quite some time. It's late August, which means we're headed to Jackson Hole for Kansas City Fed's annual symposium, attended by top central bankers from around the world. And as usual, everyone is wondering in particular just what Fed Chair Jerome Powell, who's expected to speak Friday morning, might have to say. According to Gareth Soloway, the Jackson Hole meeting would determine the next key level for most of the economic indicators. He also pointed out that it would guide the market on whether there would be more rate hikes and potentially could affect the crypto market as well. Let us now get into the video as Gareth Soloway analyzes the 10-year yield chart, the dollar chart, and where he thinks Bitcoin is headed. As you watch, don't forget to like, subscribe, and drop comments below.
The 10-year yield is very important this week because Jackson Hole is this week. Jackson Hole is the meeting in Wyoming of the Federal Reserve board members, basically. And what we can see here, and I have to bring this off here, let's bring that up. So here is your 10-year yield. Now, what I'm watching really closely on the 10-year is this high from October. And if we drag this out, you basically kissed it on Thursday, right here. You pulled back, and now you're pushing back up. If the 10-year yield breaks above 4.33%, the markets really should start to sell. Remember, when you were over here, okay, when we were over here, this is where the markets were selling off into October. They bottomed in October when the yield topped out. So the thought process is we have come off of our highs in the S&P, but the concept would be is that if you're going to break above here, at some point that pressure on yields is going to make money start to flee stocks. All right, we've had this big chase for returns. Bonds, honestly, as crazy as it is, bonds are very disliked right now, even though they're paying such a high level, because people, again, are looking at stocks and saying, wow, I got to be in the stock market. You know, this is where the big money's being made. I think that changes. I think that as yields go up, smart money, which again generally is institutional money or billionaires, they're going to start to say, hey, listen, the 10 years now paying X amount, I'm going to take some of that money out of the risk of a policy failure by the Federal Reserve, which could cause a recession and a market collapse, and move it into the bond market. So again, watch this level 4.33. Look for the S&P to start selling off if we get through that level. Okay, next up, I want to go to a couple of the charts here. I want to quickly look at the dollar. The dollar is into technical resistance here. Take a look at this chart right here. I'm going to zoom in a little bit. This is a big level on the dollar. Okay, you have a very clear pivot point here, right? Trend line, a level here, and a level here. All right, so we're right up against resistance on the US dollar. Now, the best thing for markets in the near term is the dollar to pull back. That should help asset prices. All right, if it doesn't, and you break above, short term, that could be a negative. It could also insinuate that we're seeing people flee foreign markets like Japan, which we know the yield curve control issues there, the dollar yen, China is a mess, obviously. Europe's not doing so great. It would tell us that, again, if we break up, that the U.S. is really still the game in town in terms of the dollar. So watch for that. We're right at a pivotal level. Now, I want to point something out. The yield is at a pivotal level. The dollar is at a pivotal level. All right, these are major things. In fact, gold's at a pivotal level too. Think about what we're coming into this week. Jackson Hole on Friday at 10:05 a.m. Eastern Time, a Jerome Powell major major speech. Now, this speech is important because it's going to guide the markets whether Jerome Powell is going to hike in the next couple meetings or he's going to be on the sidelines. And that's why this speech is so important, because remember, we got the minutes last week. They were very, very hawkish. So he's going to get a chance to guide us to what the rates will do. That will affect the dollar, that'll affect yields, that'll affect gold, silver, the stock market, maybe even crypto a little bit. So keep that on your radar. Bitcoin, again, guys, is very simple here. So Bitcoin, again, has broken the level I said it was likely going to break. We talked about this. You guys, it's been no surprise that when we were at 31,000, I was skeptical we were going to break out, unlike pretty much everyone else out there. But now we've fallen back down. Now the question is, here's your next support level, right? So looking at supports, we have a very clear $25,000 support, very clear 20,000 support, and if we break that, eventually you go back to the lows. The only way, and I've said this now, and this has become my thesis, is the only way Bitcoin breaks 15,700-ish, the lows, is if we see the stock market go back to the October 2022 lows or lower. Then I actually think it can. Otherwise, I think Bitcoin probably holds up relatively well. My big concern, though, is that I actually do believe the stock market is going lower significantly, as I think this narrative that it's going to be a perfect landing and everything is going to be great and we're going to all sing kumbaya, I just don't buy it. Again, history shows us that when the yield curve uninverts is when we get the recession. We haven't uninverted yet, so there's still a lot of things. We also know that there's a delay in interest rate policy of 6 to 12 months. So we're only, based on what the market's reacting to, we're at like 2.5% on the Fed funds rate versus 5.25 to 5.5.
The dollar fell from a 2-month high on Monday following 5 straight weeks of gains as risk sentiment improved in Europe, with attention already turning to the Federal Reserve's Jackson Hole Symposium, which kicks off on Friday. The dollar index, which measures the currency against 6 other majors, was last down 0.2% at 103.18, but still close to Friday's 2-month high of 103.68. Risk appetite seems a lot steadier than it has done in the last few weeks, which seems to be weighing on the dollar, said Michael Brown, market analyst at Trader X, noting that European shares are higher and Wall Street futures point to a positive open. Fed Chair Jerome Powell is set to speak on Friday, and his comments may set the direction for U.S. Treasury yields, which have driven the rise in the dollar in recent weeks. 10-year yields rose 14 basis points last week and touched a 10-month high of 4.328%, within a whisker of a 15-year high. The theme this year for the annual gathering in Wyoming is structural shifts in the global economy. 2 things that may come across are decades of ultra-low rates backed by ultra-low inflation may be over, said Vishnu Varathan, head of economics and strategy at Mizuho Bank in Singapore. And global policymakers may prefer to maintain restrictive real rates for a while. Meanwhile, the Australian dollar at $0.6420 and the New Zealand dollar at $0.5926 were pinned close to last week's 9-month lows after a rate cut from China disappointed markets worried about a stalling economy. China cut its 1-year benchmark lending rate on Monday as authorities seek to ramp up efforts to stimulate credit demand, but surprised markets by keeping the 5-year rate unchanged amid broader concerns about a rapidly weakening currency. The recovery in the world's second-largest economy has lost steam due to a worsening property slump, weak consumer spending, and tumbling credit growth, adding to the case for authorities to release more policy stimulus. However, downward pressure on the yuan means Beijing has limited room for deeper monetary easing, analysts say, as a further widening of China's yield differentials with other major economies could trigger yuan sell-offs and capital flight. The 1-year loan prime rate, LPR, was lowered by 10 basis points to 3.45% from 3.55% previously, while the 5-year LPR was left at 4.2%. The yuan has lost nearly 6% against the dollar so far this year to become one of the worst-performing Asian currencies. The reduction in the 1-year LPR came after the People's Bank of China, PBOC, unexpectedly lowered its medium-term policy rate last week. China's central bank has also pledged to keep liquidity reasonably ample and its policy precise and forceful to support the economic recovery amid rising headwinds, according to its second-quarter monetary policy implementation report. But the steady 5-year tenor caught many traders and analysts off guard, with some expecting the troubled property sector and rising default risks at some developers would have led to deeper cuts to the benchmarks. What do you think would be the outcome of the Jackson Hole's meeting? More rate hikes? Let us know your thoughts in the comment section below. Also, don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.